this is Nikhil. Yesterday, half case was explained by Sherlin. Today, I am going to explain the another half case. Before entering into the concept, I want to clear 4 points which are necessary to understand the case. The 4 points are entrepreneur, venture capitalist, investment bankers, and institutional investor. So, firstly, entrepreneur. Entrepreneur is a person who set up a business or businesses taking on financial risk in the hope of profit. So, he is the one who has the idea, who is pulling out the investments, initial investments, making prototypes, and continuing the business for venture capitalists to invest. He is the person who is the mastermind of the business, who is going to control the business. He is known as entrepreneur. Next comes the venture capitalist. Venture capitalist is a person who is already invested in some companies or is a business person who likes to invest in entrepreneur at his initial stages. He can invest an amount of money. He pools the money from different investors, small investors, and then invest in venture capitalist. Sorry, then invest in entrepreneur. Venture capitalist is a person who pools money from investors and invest in entrepreneurs. Then next concept is investment bankers. So investment bankers are the person who makes the company go public. Like they will give IPOs, in return they will they will take IPOs, and in return they will give money. Then same they will distribute the same stocks to the public market and corporation and take money from them. So this is how stock market work. If a company want to go public, it has to issue IPO that will go to investment banker. Then investment banker will sell the stocks and get the money from public market and corporation. So the here corporation is uh, institutional investors. Like there are many companies I am showing you, like SBI groups, HDFC groups, ICICI groups. These are the major companies who are going to acquire the shares and IPOs of the current businesses, and only a small bit of portion is given to normal people to invest. Major shares are holded by these groups only. To the concept, the first point, the first topic I am going to discuss is attractive returns for venture capitalists. In return for financing 1 to 2 years of company startup, venture capitalists accepted 10 times return of capital over 5 years. So the main goal of venture capitalists to invest in a possible industry where there is a growth, let the business grow with entrepreneur, help him with basic facilities like advisors, other facilities which are required for business, make the business grow, then sell the same thing to investment bankers and take an exit from the business. This is the main goal of an venture capitalist. Then there is one point highlighted here. The real upside lies in the appreciation of portfolio. The investor gets 70 to 80% of the gains, and the venture capitalist gains the remaining 20 to 30%. The amount of money any partner received beyond salary is a function of total growth of the portfolio value. So pay for performance. Like every person gets a salary, but apart from that, if they are gaining in anything, that is totally based on the company's performance. Here, there is one more interesting point in this case study. On average, good plans, people, and besides succeed only 1 in 10 times. If there is a business, entrepreneur business, only 1 is to 10. 1 in the 10 will able to success the business. And that also, the best companies might have an 80% probability of succeeding at each of them. There are many points which are considered in this. But if they lack in any one also, then it will lead to a failure of company. The points are: company has sufficient capital, management is capable and focused, product development goes as planned, production and component sourcing goes as planned, competitors behave as expected, customers want product, pricing is forecast correctly, partners are issued and are enforceable. Patents. There are different patents like IPs which they can sell and earn profit in future. Combined probability of success 17%. If any one of the factor also decreases by 50%, then the success fall to 10%. It means that these factors should work in a business to get the business successful. A, an initial business successful in market, these are the factors which are involved. Next important point is venture capitalists spend their time. Little time is required, and sometimes best not spend on the real winners or the worst performers. called numbnuts. No money, no time. Instead, the venture capitalist allocates a significant amount of time to those middle portfolio companies. Here, we can understand that if there is a venture capitalist, he should not invest his he has to give time for the companies, which was agreed while sharing the shares. They want a venture capitalist to advise them and work with them, as we have seen in Shark Tank also. So here they want to say that not only money but time is also important for companies to grow. But here a venture capitalist should not invest their time in grown companies or not performing companies, worst companies. They should invest their time in middle performance companies where they can uh, hope that the company will grow in future and they can take an exit. Whereas in non-performing companies, it is sure that that company will flop and there is no chance of saving it. Most venture capitalists distribute their time among many activities. These activities are shown below. They invest 2000 hours a year and they appoint a virtual CEO. Behalf of venture capitalist, he is the person who helps the company to grow, the entrepreneur's company, behalf of venture capitalist. So here are some points which you can see where company invest a capitalist invest his time. Hope you can see it. So generally, a venture capitalist invest in a firm for 7 to 10 years. The funds make investment over the course of first 2 or 3 years, and any investment is active for up to 5 years. The fund harvests the return over the last 2 or 3 years. It means first 2 to 3 years they invest in business, next 2 to 3 years they harvest the funds, means they take the profits from it. The average fund was about 20 millions and it two or three general partners each manage 3 to 5 investments. In 1980s, there was less craze about the investment venture capital. So they used to have about 20 millions and they used to invest in uh, 3 to 5 investments companies. But it is today the average fund is 10 times larger and each partner manages 2 to 5 times as many investments. Lanes 50 or equivalent investments, they are invested in above 50 companies. They invest 10 times money, means almost 20 200 millions. This is the point which they have tell. And another is, even though the structure of venture capital deals to seem put entrepreneurs at its steep disadvantage, the continues to submit for more the plans they actually get funded, typically by ratio more than 10 to 1. So here only one company out of 10 will get funded, but people are more attracted towards this. Many people take risk, like new ventures engineers and business people take risk of being an entrepreneur, so they can, it is like a lottery to them mentally, like if it booms it booms, if doesn't it will not boom. This is the mindset of an entrepreneur, and mainly they are new ventures engineers and business people. Many entrepreneurs also recognize the risk in starting their own business, so they shy away from using their own money. Some also recognize that they do not possess all the talent and skills required to grow and run a successful business. So here they are saying that many entrepreneurs shy to invest their own money because they don't know what will happen with the business. So they take help of venture capitalists to invest in business. Most of the entrepreneurs and management teams that start new companies come from corporation or more recent universities. So entrepreneurs recognize that their upside in companies or universities is limited by institution pay structure. The venture capitalist has no such caps. So if they take a investment from companies or universities, it is limited. But from venture capital, they don't have such cap. For all these reasons, venture capital is an attractive deal for entrepreneurs, thus who lack new ideas, fund skills, tolerance for risk to start something alone, may be quite willing to be hired into a well-funded and supported venture, but who are capable of taking risks will go for entrepreneurship. By understanding how venture capital actually works, entrepreneurs can mitigate their risk and increase their potential reward. Many entrepreneurs make the mistake of thinking that venture capitalists are looking for good ideas, when in fact they are looking for good manager in particular industry segment. So a company is a venture capitalist actually looks for a person who is more talented and can manage a business instead of a good idea. Good idea always don't lead to good management. Idea can be generated by anyone, but implementing them and showing the results can be done by a good manager who can manage his time, work, everything. So a company always needs a good manager, and entrepreneurs who satisfy this condition come to table with a strong negotiation position. The ideal candidate will also have a business track record, preferably in a prior successful IPO that makes the venture capital comfortable. His reputation will be such that investment in him will seek as prudent risk. Venture capitalists want to invest in proven successful people. So if a venture capitalist want to invest in a business, he will see that that person is capable of pulling profits, already have some business introduced, and they are successful. Then many excellent entrepreneurs are frustrated by what they see as an unfair deal process and equity position. They don't understand the basic economics of the venture business and the lack of financial alternatives available to them. The venture capitalists are usually in position of power by being the only source of capital and by having the ability to influence the network. But the lack of good manager can deal with uncertainty, high growth and high risk can provide leverage to the truly competent entrepreneur. Entrepreneur who are sought after by competing venture capitalists will be wise to ask the following questions. So these are the questions who venture capitalist is going to face when an entrepreneur clears his way out for investment. When venture capitalist is ready to invest in business, now entrepreneur also asks some questions. Who will serve our board and what is the person's position in the venture capitalist firm? How many other boards does the venture capitalist serve on? Has the venture capitalist even written and funded his or her own business plan successfully? What if any what, if any, is the venture capitalist direct operating or technical experience in the industry segment? What is the firm reputation with entrepreneurs who have been fired or involved in unsuccessful venture? So here he is asking that what is the relation with the past entrepreneurs the company has invested? Are they happy that how the company performed or how the venture capitalist helped them? Venture capitalist financial and business skills play an important role in the company's eventual success. Moreover, every company goes through a life cycle. Each stage requires a different set of management skills. The person who starts the business is seldom the person who can grow it, and that person is seldom the one who can lead a much larger company. Thus, it is unlikely that the founder will be the same person who takes the company public. So here he is saying that the founder can be changed because when a company is small, it is different of handling. But when a company gets big, it is a difficult task and can only be done by few people. So it might be different founder when the company goes for public. Ultimately, the entrepreneur need to show the venture capitalist that his team and idea fits into the venture capitalist current focus and that his equity participation and management skills will make the venture capitalist job easier and the returns higher. When the entrepreneur understand the need of the funding source and set expectations properly, both the venture capitalist and entrepreneur can profit handsome. Although venture capital has grown dramatically over a past 10 years, it still constitutes only a tiny part of US economy. The system describes here work well for the players it serves: entrepreneur, institutional investors, investment bankers, and venture capitalists themselves. These are the people who are involved in the business. It also serves the supporting cast of lawyer, advisors, and accountant. So these are the people who advise them, make the law, or any changes in product or any business strategies. These are the person, and they even give shares to them if they don't have money. So they will give 1 2 or 5% of company to them in initial stages. So here everyone can see that these are the highlighted points. You can refer to this from the video, and you can also refer the points written here. These are the main points about the study I explained. Thank you.